The big story of yesterday was the disappointing results from the biggest European company, ASML Holding, which sells equipment to chipmakers so that they could build their chips. The sales missed estimates and new orders came in way lower than expectations in Q1. They slumped by 60% compared to a quarter earlier. The key markets such as US and Taiwan, which buy the most advanced machines, showed signs of weakness, whereas China made nearly half of the revenues with less advanced products. ASML shares fell more than 6.5% in Amsterdam, and the results raised a few eyebrows regarding the sustainability of demand from chipmakers and the future of the AI rally. As such, Nvidia, which has become the icon of the AI rally, fell nearly 4%. AMD tanked nearly 6%. Intel fell more than 1.5% and TSM retreated 0.55%. TSM is due to report earnings today and is expected to report a 10% growth in its revenue compared to the same time this year. The company announced better than expected sales last week, remember? There is a chance that the TSM earnings temper the negativity that the ASML results brought on the table yesterday. But if that's not the case, the earnings season will be long until Nvidia reports in more than a month. This being said, the most popular chip makers will be comparing their results to a stellar 2023, and beating overly optimistic expectations could be challenging. Nevertheless, surprises could come from companies that massively invested in AI over the past year, like Google and Meta. And the latter could change the texture of the AI rally, and shift the attention from companies that provide the AI tools like semiconductors and cloud businesses to companies that invested in AI solutions and that should shortly start seeing return on their AI investments. In this context, the AI rally might not be over just yet, but the top two could change hands. As treasuries rebounded yesterday, shrugging off a part of the hawkishness following Fed Chair Jerome Powell's hawkish words the day before. The US 2-year yield fell after testing the 5% for the third time in 5 sessions. Citi said that investors are wrong to cut their Fed rate cut expectations and that the surprisingly strong economic growth could stall. To support that, the Fed's Beige Book noted that the US economy expanded slightly since late February, and that price increases were modest, on average. Nonetheless, it's hard to bet that there will be a rate cut from the Fed in a few weeks. Markets now anticipate just 1 or 2 rate cuts from the Fed, and the first rate cut is given more than 50% chance not before the September meeting.